You think you know the full story about the economy, but what if I told you the most common comparison people make is completely wrong? You've probably heard it before. Back in the 1980s, interest rates were at 20%. It's a shocking number, meant to make today's rates seem insignificant, but here's the secret they don't tell you. Comparing 1980 to today is like comparing an apple to a spaceship. It's not just a different time, it's a different financial universe. And understanding this difference is the key to unlocking why assets like silver are behaving the way they are right now. Stay with me, because we're about to peel back the layers of a massive economic misunderstanding that could be costing you. Let's travel back to 1980. Picture this. The Federal Reserve, led by the legendary Paul Volcker, cranked interest rates up to a staggering 20%. Why on earth would they do that? They were fighting a monster, runaway inflation that was tearing the economy apart. Prices were skyrocketing, and people's savings were evaporating. Volcker's move was like economic chemotherapy, harsh, painful, but necessary to kill the inflation disease. A 20% interest rate meant borrowing money was incredibly expensive. Getting a mortgage, a car loan, or a business loan was a financial nightmare. The goal was to slam the brakes on spending, cool down the overheated economy, and bring prices back under control. It was a short, sharp shock designed to reset the system. Now, let's fast forward. Think about the world just before and during 2020. The global economy was in a completely different state. We weren't fighting hyperinflation, we were terrified of the opposite: deflation and economic stagnation. Following the 2008 financial crisis, central banks around the world did something unprecedented. They pushed interest rates down to the floor. In the United States, the federal funds rate was effectively 0%. This was the era of free money. The goal was to encourage borrowing and spending at all costs, to keep the economic engine from seizing up completely. They wanted you to borrow, to invest, to spend, to prevent a total collapse. It was the exact opposite strategy of the 1980s. So, on one hand, you have the 1980s with 20% rates to stop spending. On the other hand, you have 2020 with 0% rates to encourage spending. These are two fundamentally different economic philosophies for two fundamentally different problems. It's not a simple high versus low comparison. It's a reflection of entirely different economic worlds. Bringing up the 20% figure from 1980 to downplay today's situation is intellectually dishonest. It ignores the why, it ignores the context. So where are we today? We're in a third unique environment. Today's interest rate is around 4 to 5%. Now, if you just listen to the headlines, you might think, well, 5% is nothing compared to 20%, and you'd be missing the entire point. The reason today's 5% feels so significant, so painful for many, is because we're coming from zero. The change is what matters. The economy, businesses, and consumers all got addicted to a decade of nearly free money. We built our financial lives around it. Mortgages were cheap, credit was easy, and companies could borrow massive amounts to expand. The jump from 0% to 5% is a seismic shock to this system. It's like a deep-sea fish that has only ever known the crushing pressure of the abyss suddenly being brought to the surface. The change in environment is what causes the damage. That's why we're seeing stress in the banking sector, why the housing market is locking up, and why people are feeling the squeeze on their budgets. The absolute number, 5%, is less important than the relative shock of the increase. This isn't the 1980s where the economy was braced for high rates. This is an economy addicted to low rates, suddenly going through withdrawal. And here's the crucial part of the puzzle that brings us to silver. What is the market telling us? What is the expectation? The consensus among many economists and market watchers is that these rates are not sustainable. The Federal Reserve raised rates to fight the inflation that was sparked by all that money printing and supply chain chaos. But now, the high rates themselves are starting to crack the foundation of the economy. The government's own debt is becoming astronomically expensive to service. And with over $34 trillion in debt, every percentage point increase in interest costs the U.S. government hundreds of billions of dollars more per year. It's a debt spiral. This creates a dilemma for the Fed. They can't keep rates high forever without risking a severe recession or a financial crisis. The pressure to cut rates is building. And this is not just a guess, it's what the bond market is pricing in. The expectation is that sooner or later they will have to pivot and start lowering interest rates again. They'll have to go back to stimulating the economy. This is where silver enters the picture. Silver, much like gold, has been considered a monetary metal for thousands of years. It's a real tangible asset. It doesn't have counterparty risk, meaning you don't need to trust a bank or a government for it to have value. When investors anticipate that a central bank is going to have to lower interest rates and inevitably print more money to manage its debt, they look for a safe haven. They look for something that can't be devalued by a printing press. Lower interest rates are like rocket fuel for precious metals. When interest rates on government bonds or savings accounts are high, they offer a good, safe return. This makes holding a non-yielding asset like silver less attractive. Why hold a metal that pays you nothing when you can get a guaranteed 5% from a treasury bill? But when interest rates are expected to fall, the opposite becomes true. That opportunity cost of holding silver disappears if bonds are only going to pay 2% or 1% or even go back to 0%. Then holding a real asset that protects your purchasing power from future inflation becomes incredibly appealing. So, the rise in silver we're seeing isn't happening in a vacuum. It's not some random speculative frenzy. It's a calculated move by smart investors who see the writing on the wall. They are looking past today's rates and positioning for the future they see coming. A future of lower rates and more currency creation. They understand that the current environment is not the 1980s. The debt is too high, the system is too fragile, and the political will to endure a true Volcker-style recession simply isn't there. They see that central banks are trapped, damned if they keep rates high and damned if they cut them and risk reigniting inflation. In that environment of uncertainty and currency debasement, physical assets like silver shine. It's a vote of no confidence in the long-term stability of fiat currency. The market is forward-looking. It's not reacting to today's 5% rate, it's reacting to the expected 3%, 2%, or whatever comes next. It's reacting to the trillions in debt that make a return to normal monetary policy almost impossible. So, the next time you hear someone dismiss today's economic challenges by bringing up the 20% interest rates of 1980, you can see right through it. You'll know that we're not just in a different chapter, we're in a completely different book. The rules have changed. We've gone from a world of fighting inflation with high rates to a world of fighting deflation with zero rates to our current fragile world of trying to manage the consequences. And in this new world, the reasons for silver's rise are clearer than ever. It's not just a metal, it's a message. It's a signal that the financial landscape is shifting in a fundamental way. Understanding this context is everything. It allows you to look past the noise and see the real forces at play. It's about recognizing that history doesn't always repeat, but it often rhymes. The rhyme we're hearing today is one of monetary uncertainty, and savvy investors are listening closely. Thank you so much for watching. If this video helped you see the economy in a new light, make sure to hit that like button and subscribe for more content that cuts through the noise. Let me know your thoughts in the comments below. See you in the next video.